can. If you're new to the weekly webinars we do here at MicroQuant, we try to keep them around 30 minutes long, so we try to respect your time. We know a lot of you are very busy, so we try to finish up right around 9 o'clock and then answer as many questions as we can. Very quickly before we get started, just a generalized risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. We're also required to show you the CFTC Rule 4.41, which is just a hypothetical disclaimer saying that all the examples we'll be using tonight are for hypothetical purposes only. They're for training and education purposes only. We're not guaranteeing that they will work again in the future, and we're not saying that we placed all these trades in the past, although many of them we did place ourselves. Now, what's the goal of this strategy that we're going to be discussing tonight? What's the goal of trading a trendline break in crude oil? We're trying to strategically enter into a longer short position based off the support or resistance. Now, what's support or resistance? What support or resistance is a price that has historically turned the market in the past, meaning the market has come down to it, hit that price level, and bounced and gone to the opposite level or in the opposite direction. So that becomes support. If it's resistance, it's going to be above it, so the market will have come up to it before, hit it, and bounced off and gone down. So what we're looking to do is trade the break, because many times when a resistance level or a support level is broken, what happens is the market will break through it and then really start to run and move in the opposite direction. So we're looking to catch this move right here from the break to the rest of the upside. Now, again, we're trying to catch the big move, and we're trying to risk as small of an amount as possible. Now, you would think this would be obvious with every trading strategy out there, but I just want to make sure that's clear, because the goal of this strategy is to catch the wave basically after the market starts to run once it breaks through, and we're trying to use as tight of a stop loss as possible while still being able to maintain that position, get into it, and hold it for the entirety of that move. Now, how do you trade this strategy, and how does this help you? First thing you need to be doing is identifying the support and resistance. This is the first thing I do every day before I start trading. I'll go and I'll look at every market that I trade, and I look at the support and resistance levels and the trend lines. So first thing you do for the strategy, identify the support and resistance. Second thing you can do, if you're looking to trade the break in the support or resistance, meaning you're trying to catch that move after the market breaks through and starts to run, you put a limit order immediately outside of that support or resistance. Now, you will see false breakouts. So there's a couple things that have to happen in order for the strategy to be successful. If this is your support level and the market has bounced off it in the past and you're looking for it to break through, you're putting your limit order right here. So as soon as it breaks through, it's going to hit your limit. Now what's going to happen is you want to see immediate follow-through, meaning you don't want to see this market stall out and move sideways and potentially come back up. What you want to see is it hit that limit order and then continue to push down. As soon as your limit is hit, your stop loss is being placed right on the other side of that support or resistance level. So here's your limit for your entry, and here's your stop loss once your limit is hit. That way you're catching it as soon as it breaks out of that support, and you're trying to catch that big move as it continues to run. And then you're putting your stop loss right on the other side of the support, because technically speaking, if a support is broken, it's then going to become resistance, and this market should never go back up above it if this strategy is going to work. And if it is, then you want to be out of it. So again, you're using limit orders and you're placing stops on the opposing side or the opposite side of the support or resistance once your limit is hit. And this also works pretty well a lot of times during news announcements. So a market you'll see before a news announcement, it'll be trading in a channel essentially. So you'll have support and resistance right here, and your news announcement's coming out. What you can do is you place your limit, either your buy limit there or your sell limit here, and after the news announcement, a lot of times the market will either spike up or spike down, and what you're doing is you're catching that move as soon as it breaks through that support or resistance, and you're looking to catch the rest of that move to the downside or to the upside. And again, once it breaks through your support or resistance and it hits your limit, your stop goes right inside of the support or resistance. Now again, number 3, you're trying to catch the big move either from the bounce or from the break. You're not trying to basically anticipate it. So there's another thing that you can do when trading the support or resistance. Here's your resistance level. Okay, you know that historically speaking, this market has bounced off of that resistance. So what you can do is you put a limit for a short right next to that resistance. Then you put your stop loss for that short right on the other side with an additional contract or two to catch the move to the upside. So if it's going to respect that resistance and bounce off of it, it'll hit your short limit, so you have a short position to catch the bounce to the downside. If it breaks through, you have a small loss because you're getting in with limit order right next to the resistance, and your stop loss is just over on the other side, so you're risking just a few ticks. If it breaks through that resistance and is not going to hold where you wanted it to hold, then you're going to hit your limit. It's going to reverse your position, and you're going to be long trying to catch the opposing move. Now, the one thing you have to be careful of with doing that is for false breakouts, and that's when a market, give me 1 second, I'll erase this ink. That's when here's your resistance level, here's your limits. The market's bounced off the resistance before, it's coming up, it hits it, has a false breakout, so it hits your other limit, and then it reverses and comes back down. You want to see immediate follow through when it breaks through the support or resistance. So you really want to see that market start to run as soon as it breaks through. You don't want to see it stall out, and you absolutely don't want to see it come back down through the support or resistance. Now, we'll go ahead and take a look at a few examples of how this works in crude oil. Once we're done with the examples, we'll go through and I'll answer as many questions as I can regarding trading these support and resistance levels. Now, the same thing works as well with trend lines. So again, support resistance is going to be a price point that has turned the market in the past. And when I say turned the market, I mean turned it a significant distance. So it's either come down, hit that point, and bounced quite a bit, or it's come down, hit it, then come down, hit it, and come down, hit it again, like that. So it doesn't have to necessarily have bounced a huge distance as long as it's hit it multiple times. If it bounced a large distance, then it's still considered a support level. And again, the same thing works with trend lines. So here's an example in crude, and this is actually one we traded in the live trading room. For those of you that were here, this was just yesterday, I believe. What we had is we had a channel in crude, and we were saying, okay, we're going to trade the break. So we had the support from these lows here. Every time this market hit that support, and then we had resistance from the highs here. And what you're doing is you're putting your limit for a sell right below the channel, and your limit for a buy right above the channel. You can see we had a false breakout here, but even this false breakout, even though it did end up coming back up, you are still in the money on crude oil on this 30-minute chart from, call it 92.50, went all the way down to a low of 92.10 roughly, so 30 or 40 ticks in your direction, which is $400 a contract. So not a bad move, even if you traded the breakout to the downside. You did come all the way down and hit significantly undervalued, as shown by the lower red bar segment, according to value bars, which would have been your profit target. So again, you had a very nice trade, several $100s a contract, and you really didn't have to risk very much at all, because again, your limit goes right below the support. As soon as it's hit, your stop loss goes right inside the resistance. Remember, once a support level is broken, it then becomes resistance, and once a resistance level is broken, it then becomes support. The next opportunity you had So once it came back up and was back inside this channel, now you're saying, okay, the support is now gone, so we're looking for a potential breakout to the upside. So you have your limit to go long at the upside. As soon as it breaks through, you're getting long, and you can see that market moved all the way from, call it 93.20 all the way up to 94.20 by the end of the day. So you caught that entire upside move, and you were risking roughly 10 ticks with your stop loss, which is about $100 a contract, and you caught a $1,000 contract move by trading the break. So as soon as it broke out, you can see it broke out with a lot of momentum and then just continued on heading higher, which is exactly what you want to see when you're trading a breakout. As I mentioned, you don't want to see it kind of dance around and then come back in. Now, you can be doing the same thing every time you make new support levels. Okay, so you could technically say there's support level 1, there's support level 2, here's support level 3, here's support level 4 as it moves up. And then what you can be doing is either stepping your stop loss up every time you form a new support. So your stop gets moved right there, stop gets moved right there, stop gets moved right below the new support every time the market moves up. That's one way to trail your stop. The other thing you can be doing is looking for breaks of the resistance. So you could say there's your resistance at the high, here's resistance at the high, here's resistance at the high. You can see the last one didn't end up getting broken. The first couple did, so you could have had additional limit orders in to get long all the way up as that market was continuing to form new resistance and new support levels. Now you can trade it on any time frame. Here's an example today. This is what happened as crude oil continued to move lower and lower and lower today. We're looking at a couple different support levels. Okay, the first one, if I can draw a straight line, is actually coming across right there. Now you had a false breakout where it broke out and then rallied right back up and then broke out again. So it broke out of the support, bounced up, knocked out all those stops, and then ran again. So you have to be willing occasionally to put your stop or put your limit back in place and be careful of those breakouts. One of the things I typically do when trading a breakout strategy like this, where the market's going to break through a support or resistance, I'll put my stop at break even very, very soon. And those of you that are in the live trading room, you know I typically move my stop to break even when I'm up around $100 a contract, especially when I'm trying to basically catch the wave like this, because when you do it right, you can see here on the 15-minute chart, crude oil broke through the second time and then just took off and never looked back and dropped from 93.90, call it, and went all the way down to 92.60, 92.50 area. The next support level is going to be off of this low right here where it's highlighted. The reason that's the support level is because it caused a significant bounce in the market. Remember, you want to see a significant move from that price point. So you said market came down, bounced off of it for almost an hour, did nothing but go higher off of that support level. Then it ended up rolling back over and heading lower. But you see you had a bounce from around 93.70 all the way back up to 94.10. So you had a 40-tick bounce. I would consider that a pretty significant move. So you have support, your limit goes just on the other side of that support level. As soon as it breaks through and hits your limit order for the sell, your stop loss goes right above the support, because technically speaking it should never come back above that support once it's broken, and then you catch the rest of that move. Again, you're short from 93.70 roughly, and it goes all the way down to 92.70, so you're made over $1,000 a contract to the downside on that first break. Your second break is going to be from these supports here, and again you can see came down, hit it once, and rallied right back up. It's about a 30-tick rally, and then again about a 25-tick rally back to the upside. They're roughly right in the same area, so there's your support right at around 93.12. Again, limit order goes just on the other side of the support. You're waiting for the break, so you want to see the market break through that support. As soon as it breaks the support, you're getting short because you have your limit order in, and as soon as your limit is filled, you're putting your stop right on the other side. You can see it ended up running very nicely the rest of the way down for the rest of the day. So again, you're looking for the price points that have turned the market in the past, then you're putting your limit order on the opposing side of that support or resistance. Let's take a look at crude on a 60-minute chart. Now remember I had said if it goes, the support or resistance is either it's turned the market a large amount in the past, or the market's bounced off of that price point multiple times. Here's a great example of where it's bounced off of it multiple times. This is on a 60-minute chart. So here's your resistance. It's hit it 1, 2, 3, 4, 5, 6, 7, 8 times roughly. So again, you're looking to put your stop loss or your limit order right on the other side of that market. As soon as it breaks through that resistance, your limit's getting hit, your stop is going just inside of your support. Now, depending on how aggressive or conservative you were with your stop placement, if you were more conservative, you gave it a little bit more room, which allowed you to stay in it even though it broke back down for just a minute back inside and then took off to the upside. So again, limit order right on the other side. As soon as it breaks through, you're getting filled or you're long. And you can watch as well, occasionally, like I said, a market or what it was once a resistance level becomes your new support. And sometimes you'll get a retest of that support like we did here, where it came back down, just about hit that support before heading higher. It's up to you how you want to trade it, whether or not you want to be stepping your stop loss up or if you want to try to let it run. With longer time frames, you got to remember you're looking for a longer break or a longer move in the market. So for example here, this limit got you long from, call it 98 or 90.90, and this market rallied all the way up the rest of the day to a high of about 92.10. So very nice move. Again, over $1,000 a contract to the upside. You're risking about $200 a contract with your stop loss. The other thing you have to keep in mind, if you're trading a support or resistance level on a 60-minute chart, your stop is going to be looser than if you were trading it on a 5-minute chart or a 2-minute chart. So keep that in mind. I know many traders like doing swing trading. You can trade the same way with swing trading using dailies or 240-minute charts. You can also do day trading or scalping using 2-minute or 5-minute charts for support and resistance. Now, here's an example, like I said, limit orders using 2-minute charts for day trading. Here's a 2-minute chart of crude oil. We have our support and resistance, because remember, once resistance is broken, it's your new support. So here was the resistance previously. It broke through, and then it became support. So what you're looking to do is short it on the break. So right here, you actually had a false breakout initially, but then when it broke back through it the second time, you actually caught the rest of that move. Now, one of the things you can try to do to limit your exposure to false breakouts is, instead of putting your stop loss or your limit order immediately on the other side of that trend line or the support or resistance level, what you're doing is you're putting your limit order a few ticks beyond it. So you want to see that market really move through it. And again, if it doesn't immediately pick up steam and strength to the direction that you're trading, then a lot of times it will be a false breakout. So you got to be very careful and be watching it. And that's why you're immediately putting your stop loss back inside of that resistance level. Because if it does reverse like this, you want to be out of it. You don't want to experience that move back to the upside. But again, even here on a 2-minute basis, once it broke through and hit your limit, it moved from, call it 94.30 all the way down to a low of roughly 94, so just about $300 a contract. Now you got to keep in mind as well, your profit targets on a 2-minute support or resistance break are going to be reached much sooner, because you're really only trading on these super short time frames if you're looking for scalping. So those are all the examples. Now, pretty simple strategy. Like I said, we try to keep it right around 30 minutes long here for the webinars. Again, pretty easy. If you have any questions, I'd be more than happy to answer those now. How many ticks do you use for the limit order on the opposing side of support or resistance? That depends on the time frame that you're trading on. For a 2-minute chart, I'll do 4 or 5 ticks maybe. For a 60-minute chart, I'll do 10 ticks maybe. Again, if you're trading on a short time frame, a 1 or 2-minute chart, or even a tick chart, then your targets are going to be reached much sooner. You got to remember that it's scalping, so you got to keep in mind that you're looking for that shorter time frame move. Whereas if you're looking on a 60-minute chart, you're looking for a much larger move. So you want a much larger breakout. And again, this works really well a lot of times with news announcements, where you really want to see that market run once it breaks, because a lot of times you'll have your news announcement, the market will just be pretty choppy until it happens, and then the market will break after the announcement. Does this work with gold and the E-mini S&P futures? Absolutely, it does work with gold and the E-mini S&P futures. We trade trendline breaks in gold all the time in the live trading room. How do you fine-tune your entry on a 60-minute chart? Honestly, it depends on the market that you're trading, and it depends on the strength of the break. So when you see a break, you want to see a lot of momentum. For example, here we're using MQ momentum indicator. You want to see that market continue to pick up momentum and gain strength in the direction of the break after it breaks. And again, you want to see the immediate follow through once you place that trade. So really the only way that you can quote unquote fine tune it is by experiencing it, by watching it. A lot of markets, you just have to get used to it. For example, gold really starts to run when it breaks trend lines. Crude oil can oftentimes run when you break support and resistance levels. It doesn't follow trend lines quite as closely as gold does. And wheat's another one that follows trend lines pretty well, and so is the Canadian dollar. We actually traded a Canadian dollar trendline break earlier this morning in the trading room, and you had the ability to take out 30 or 40 ticks off of the break on a 240-minute Canadian dollar trend line. Do I use any confirmation? Again, for the confirmation, you're looking for the increasing momentum in your direction, and you're looking for the immediate follow-through once the trend line or the support or resistance has been broken. And this is, again, you'll see us trade this quite often if you're in the live trading room, and we'll try to trade it some tomorrow. We'll watch for support and resistance levels and trend lines. For those of you that will come to the open house, for all the newsletter subscribers, you'll see us how we trade this in the live trading room tomorrow. Are there best times to trade crude? I prefer trading crude between about 6 a.m. and 2 p.m. That's when there's a lot of volume. It's pretty easy to get in and out of. Your spreads are pretty tight, and it actually moves much more during those times than if you're trading it, for example, right now. How do you set your regression moving average exponentials? My MQ regression, which is this red and green line, is that what you're talking about? We have that set. I just use that set as a 100 bar setting for every time frame I'm looking at. It gives you a little bit longer trend analysis. You can see it had you in an uptrend all the way up this market and then rolled over right at that cross, switched you back to a downtrend for crude oil. So I use a 100 bar regression on that. Do I look at other possible confirmations? Absolutely. I look at divergences. For example, here's a great bearish divergence. There's top one, here's top two. You have higher high compared to your first top with a lower high histogram. So top one, top two, you have a lower high on the second one compared to the first one. So I'll look for divergences. If it has a divergence, so if it's a trend line, it's coming up to that trend line. So here's my resistance. It's coming up to the resistance, and it has a bearish divergence. Instead of putting a limit there, I'll more than likely go short instead and try to catch the drop. If it's coming back up towards the resistance with a lot of momentum, so it's picking up strength as it's moving higher, then I'll be more looking for the breakout than I would looking for the short. How do you join the open house? You can join the open house. You go to ValueCharts.com. You enter your email address, sign up for the free newsletter, and then we'll send you an invitation to join tomorrow. The live trading room is open from 8 a.m. until 12 noon Eastern Standard Time. Do I trade crude during the inventory report on Wednesday or stay out of the market? There's a few different ways we trade the reports, the crude oil or the petroleum status reports. We trade breaks, which is what we're talking about here. We trade bounces. A lot of times you'll see a market, it'll break higher or it'll break lower. It'll bounce and then continue on like this. Those are one of the strategies we use. The last strategy that we use for news announcements is you'll see a break, your bounce, and then you'll see a divergence and you'll go counter trend, trying to catch that divergence, watching it on a 1, 2, or 5 minute chart. looking for the divergence and catching a scalp in the opposite direction. All of them work pretty well. We've had pretty good success trading all the different strategies. For example, I like using this example because it's pretty neat. We've made $1,000 a contract trading corn here a few months ago in the live trading room, trading the break like we're talking about now. Had a limit order in, the crop report came out, it broke through, hit the limit and took off, never looked back. In about 30 seconds we were up $1,000 a contract, closed it out and locked in the profits. What regression value do you use for the S&P? I use a 100 bar regression for all the markets. The trading room is great. Thanks, Rob. I'm glad you enjoy it. All right, so if there's no more questions, then that's going to conclude today's webinar. Again, if you want access to the live trading room, sign up for the newsletter at ValueCharts.com. One thing I would say to look for is if you don't get the link, if it doesn't arrive in your email, check your spam folder. Occasionally it'll get sent to your spam folder. So check that, make sure you have it, and I look forward to seeing you bright and early tomorrow morning. And we have a lot of news announcements coming out, so it's going to be a very exciting trading day. Again, that concludes tonight's webinar. Thank you all for coming, and I will see you tomorrow in the trading room.